Hi everyone, in this video we're going to talk about capital cost allowance. Now as you probably know from watching your lecture, you cannot take amortization or depreciation as you know it from accounting in tax. In tax they have something else called capital cost allowance. Now a lot of those rules and details with respect to capital cost allowance have been covered already in your lecture. In this video we're just going to take a look at what some of those provisions look like in the Income Tax Act. So grab your Income Tax Act and let's get started. We'll begin by navigating to ITA 20, subsection 1, paragraph A. Here we are in 20, subsection 1, and it says deductions permitted in computing income from a business or property. It eventually goes on to say that there may be deducted such of the following amounts as are wholly applicable to that source or such part of the following amounts as may reasonably be regarded as applicable thereto. In other words, the paragraphs that follow are going to describe the types of amounts that can be deducted when computing income from a business or property. And the very first one is paragraph A, capital cost of property, often referred to as CCA, or capital cost allowance. Such part of the capital cost to the taxpayer of property, or such amount in respect of capital cost to the taxpayer of property, if any, as is allowed by regulation. So a few things there. First, we can't necessarily deduct everything. It's a part of the capital cost, and it has to be allowed by regulation. Before we go any further, you can take a quick look at the notes, which might be helpful to you. But they basically explain there that the capital cost allowance is claimed in place of accounting depreciation or amortization. Capital expenses are otherwise non-deductible, and that's according to 18(1)(b). There's some more helpful information here. CCA is allowed by class, commonly referred to as a pool, rather than by an individual asset, and the rates are set out in Regulation 1100. And the classes of property are in Schedule 2 at the end of the regulations. Some assets, however, are deemed to be a separate class, and for that we'll go to Regulation 1101. CCA for most classes is claimed as a percentage of a declining balance. Depending on your version of the Income Tax Act, you might have to flip the page to just confirm what regulation you need to go to, and you need to go to Part 11 where you'll find the CCA rules. And you'll also have to refer to certain schedules in the regulation, specifically Schedule 2. So that's 21A in a nutshell. It basically says you're allowed to deduct something, and it's called the capital cost allowance. The amount you're allowed to deduct, that has to be done according to regulation. So let's go to the regulation now. Please navigate to Regulation 1100, subsection 1. When you get to the Regulation 1100, subsection 1, it'll start off by saying for the purposes of paragraph 81J and P and 21A of the Act, and 21A is where we are coming from, the following deductions are allowed in computing a taxpayer's income for each taxation year. And then paragraph A gives you the rate for each class. For example, a Class 1 asset would see capital cost allowance taken at a declining balance rate of 4%. Class 2 would be 6%, Class 3 would be 5%, Class 4 would be 6%, and on and on and on it goes. I think you're starting to get the idea. What you aren't seeing, however, is what type of assets go into each class. And that's what Schedule 2 is for. It's time to navigate to the next part of the Tax Act. And here is Schedule 2. And under Schedule 2, you'll see each class listed. Here's Class 1 for 4%. And it says property not included in any other class, that is paragraph A, a bridge, B, a canal, C, a culvert, D, a dam, E, a jetty, acquired before May 26, 1976. F, a mole, acquired before May 26, 1976. And on and on and on it goes. When I was in industry, one of the first capital assets that I was responsible for acquiring was a photocopier. So why don't you take a couple of minutes, go through Schedule 2 to see if you can find a photocopier? Go ahead. I'll wait. Dear Diary, I went for a bike ride today for the first time in over 15 years. After 5 minutes, I thought I was going to die, and my life flashed before my eyes. Let me tell you all about it. There, was that enough time? Did you find it? Maybe some of you did, maybe some of you went to the index to try to look it up. Look, it doesn't really matter for right now. The point that I was trying to make is that it can be very time consuming to look up a specific asset in the Income Tax Act using the physical version of the ITA. So on an exam, usually we'll just give you the class that you need for the particular asset in the question. Not bad, huh? Unless, of course, it's a go find it question where you have to look it up. Now, your lecture and readings would have made reference to some other rules that you need to be aware of. Let's keep going in the Income Tax Act to find where they are. The first year rule, Regulation 1100, subsection 2. Regulation 1100, subsection 2 talks about property acquired in the year. It's commonly referred to as the first year rule. And this rule basically specifies that the amount of CCA that a taxpayer can take in the first year or in the year the asset is acquired is going to be limited by a formula. Now, what you need to know about the first year rule is going to be covered in your lecture, covered in your readings, but you might find it useful at least to know where this provision is and maybe look at the notes as well. The notes to Regulation 1100, subsection 2, also talks about the Accelerated Investment Initiative and the pre-2019 half-year rule. ITA Regulation 1100, subsection 3. 1100 subsection 3 deals with taxation years that are less than 12 months. Basically, in a short taxation year, you would prorate the CCA by the number of days in the year, and you would use the number of days as is indicated in the wording of the provision. The number of days divided by 365 days in the year. Naturally, some of you might be wondering about the final year of a business. Well, after all assets have been disposed of in the final year of a business, there would be no partial year CCA deduction in that business. However, if there's an acquisition of control that occurs in the middle of a taxation year, and there's a deemed year end, there probably would be end of year UCC balances, and the amount of CCA deducted in those instances would be determined by the short fiscal year rule that you find here. That's a more advanced topic, however. So for you, you really just need to be aware of the fact that if there's a short fiscal year, you should be using the number of days to prorate. The readings and lecture would have referred to a few other items that are relevant for capital cost allowance. One term you'll hear a lot is the undepreciated capital cost. How much of the capital cost has not been depreciated yet? We commonly refer to that as the UCC. Let's navigate to where that is in the Income Tax Act. ITA 13, subsection 21, the definition of undepreciated capital cost, commonly referred to as UCC. You'll note here that the undepreciated capital cost to a taxpayer of a depreciable property of a prescribed class as of any time means the amount determined by the formula, and you're looking at a formula that's going to be a lot more involved than anything you'll find described in an introductory taxation textbook. You don't need all elements of this formula for intro tax. Still, if you forget what any elements are, you can always flip the page to find each term defined. And you might find the notes to be somewhat helpful as well. For example, the capital cost allowance, the deduction that we are trying to calculate, is normally claimed as a percentage of the undepreciated capital cost. Put simply, and ignoring special case exceptions, UCC of a class is the original cost of the property in the class plus the prior year's recapture minus E, the CCA claim till now, minus F, the proceeds of disposition of any property sold, up to a limit of the original cost. Let's navigate further. ITA 13, subsection 1, recaptured depreciation. Recapture refers to an amount that needs to be brought back into income, and the provision is here. So if you don't remember what recapture is, recall that when depreciable property is sold, the proceeds of disposition up to the original cost are deducted from the UCC of the class. If, as a result of that, the UCC goes negative, 13 subsection 1, where we are now, requires the balance to be included in income. And this is called recapture of CCA that was claimed. Conceptually, too much CCA was claimed since the property was sold for more than the UCC. ITA 20, subsection 16. Terminal loss. This is, in a lot of ways, the opposite of recapture. Okay, a terminal loss is available as a deduction if all depreciable property in a class is disposed of and there is still some unused cost, UCC that is, left over. That amount can then be deducted and we call it a terminal loss. Now we have some questions that are connected to all of these different provisions for you to try and practice. We'll do a video that debriefs at least one of them, and the rest we'll do either live with you or post solutions. So please keep a lookout for those, and until next time, thanks for watching.